The first thing that we have to understand is if you go back to 2010, post-financial crisis, there was an onslaught of investment that came in from foreigners into the US markets, which means you have to buy the dollar. If you look at the Fed's broad dollar trade weighted index, a very, good index and measure to look at the dollar, that index shows a dollar appreciation since 2010 to the end of 2024 of about 40%, which means that the dollar is very expensive and
Okay.
people are overweight. Foreigners are overweight US assets. What we're seeing right now is a rebalancing. We're not seeing a sale, a liquidation of dollars, a loss of faith, a loss of confidence. None of that is really taking place. What you're seeing is people who are overweight US assets. Now we have tariffs and what have you, and US assets, equities are kind of moving sideways. People are repatriating. And what that means is that the dollar is going to weaken, but from very expensive levels. And I think that's an important caveat to actually make in this whole story here. So, look, I do think the dollar is going to weaken. But I don't think that it's cause for alarm. I think we have to put this into context.
So again, Jim, so real quick here, what's the number one issue you're talking with clients these days at Morgan Stanley?
So what does it mean when the dollar starts to weaken like this, right? What does it mean when it starts to sell off from very expensive levels? It means that bond yields have to make the adjustment.
Okay.
So effectively what it tells us is that longer term bond yields will not go down as much as what we had previously seen over the last 15 years. So a lot of the relationships that we look at, like, oh, the equity market's down, how come bond yields aren't down more? Or why isn't the bond market supporting the equity market as much? It's because this rebalancing is taking place. So what we're telling clients is that when you start to construct a portfolio of fixed income and equities and alternatives, and you put everything together, essentially we have to understand that bonds will not hedge your equity risk like they did in the past, at least not longer duration bonds. So what we're telling clients is that shorter duration bonds, front end bonds, 2-year yields around 365. I mean, that's being controlled by Fed and Fed policy and
Right.
expectations. Shorter term bonds are actually good. Longer term bonds are going to be a little bit more risky, and we see a yield curve
Okay.
steepener.